No, the market is not going to crash. Everything is going to be just fine. And that's exactly what John Gafford is telling us today here on the Fearless Investor Podcast. Hey, welcome in. This is Kyle Stanley here with the Fearless Investor Podcast. I appreciate you joining us in our makeshift area in Arizona right now, just visiting some friends. And so I am right in front of their closet doing this podcast. So we do what we can. And that's the great thing about working remotely. I can do this from anywhere. So sorry if you're watching on the YouTube channel. It's not the most aesthetically pleasing thing right now, but I'm excited today about the content that we're bringing you from John Gafford. He is a real estate entrepreneur in Vegas, has a totally vertically integrated business. I met him back in Vegas in November at one of my buddy Travis Chappell's events. And just was a guy that you could tell had tons of knowledge about real estate, started following all of his content on Instagram, on Facebook. And he shared a really interesting video the other day. And I'm going to get to that in just a second. But before we do, I got to give a shout out as usual to the fans, the audience members that are engaging with our content. And this one comes from David Concepcion or Concepcion. Sorry if I'm saying that incorrect. Kyle has great information on Airbnb. Thanks for sharing and showing extra opportunities to invest in Airbnb. David, thank you for commenting. Again, guys, if you comment with something like that, or if you review, if you rate the show on the podcast, we are going to mention you on the show. So make sure that you go and do that if you haven't already. Now, again, getting back to John Gafford, we are going to talk to him about where the 2020 housing market is at, where is it going to Q3, Q4, but also into 2021. And John has a very, very opinionated stance of it's not going anywhere. It's actually going to be very strong still. And he's going to tell you exactly why. So let's get to it with John Gafford. Hey guys, welcome into another episode of the Fearless Investor. I've got a real special treat today. John Gafford coming in from Vegas. And we are talking about everything that's going on right now in the world. There's so many people. I reached out to John because I was really excited about he's got a very strong opinion about where he thinks the market is going. It's different from what we've heard before. So I'm excited to bring John in and talk about where this 2020 and beyond market is going. So John, thanks for joining us today. I appreciate you being on.
You're welcome, man. And before we even get started, I want to tell you something, which is I loved your Grant Cardone video.
Oh, did you?
I loved that video. I think there has not been somebody more dangerous to the real estate industry as a whole in the last 10 years than Grant Cardone is right now. I totally love that video.
Well, thank you. I appreciate that. Can you just expand on that for 1 second? I know that's not what we're talking about, but since you brought it up, when you say dangerous, tell me what your thought is.
Well, for example, like today, we're going to have a conversation and we're going to talk about where I think the real estate market, especially here in Vegas, is kind of headed and what's going on with it, and kind of give a counterpoint to some of the stuff that's going out there. Some of the things that I'm going to say, you as a consumer need to take with a grain of salt. And why is that? It's because a great part of my income and a great part of my life comes from the buying and selling of real estate. That's a fact of it. So for me, it is more advantageous if that continues to happen in my day-to-day life. Now, the reason that I say that that's important and how that ties back to Grant Cardone is this is a guy that goes every time he gets in front of a camera and says, don't buy a house. Yep. Don't buy a house. Having equity in your house is stupid. It's the dumbest thing you can have. What are you, your grandparents? Or don't do this. Here's what you need to do instead. Send me the money that you would have spent for yourself on a down payment, and I'm going to invest that money, and we're going to cash flow. We're going to cash flow. So his entire life is predicated on you believing that piece of advice. And I think anytime people start taking advice from somebody that their entire life is predicated on them believing it, not enough people question what that dude says. And that's my problem with that. So.
Yeah. I think a lot of it came out when he started really showing his true colors here recently. There's a lot of things that led up to that we talked about in the video, but the argument of, especially for someone like you, I mean, you've been a realtor for how long?
I've been in this business since 2006. So I've been in 14 years doing this, but I've seen a lot.
I mean, at the end of the day, I understand some of his arguments when it comes to rent versus buy, but if you've got the money and you're going to be staying put in one place for a long time, why wouldn't you spend money on something that's going to pay you back in the future, right?
Well, and here's another thing. Obviously, Grant's not very plugged into his family because my children, if you have kids, their entire life becomes wherever they go to elementary school. Their friend set, your friend set morphs into that. It really, those elementary schools, even if they're private schools, wherever they are, become the fabric that binds us as a community. And to insinuate that everybody should just be a transient and you should treat a house like you treat a hospital is just insane to me. It makes no, and let's be very clear. He owns the house he lives in. It's just not in his personal name. Let's be very clear about that.
There's a lot of things that I think are not spoken to the public from Grant that are actually the truth. But hey, that's
what we're talking about today.
Yeah, exactly. Not what we're talking about today. But before we do get into where you think this market is headed, I do want people to understand a little bit more about you. Tell us where you came from, what got you into real estate. You're running a huge business over there in Vegas now. I'd love people to just hear all about you.
Well, let's see. I got into real estate in 2006, but prior to doing this, I was in the tech industry. I was on a reality show, and I got fired by our sitting president on live television. You can figure out what show that was. And right coming off of that show, I wound up selling we got rid of our tech firm, and the girl that won my season of The Apprentice, Kendra Todd, dear friend of mine, said, "Why don't you get a real estate license and come to sell real estate with me? It'll be fun." And this was 2005, I guess it was. So I was like, "All right, sure, it'll be fun, something to do."
Can you pause for a second? Because when I met you, that story about Trump, what you said to him, can you just tell people what you said to him? You stormed back in, right? You stormed back in.
No. That wasn't Trump. That was Burnett.
Oh, okay.
People ask me how I got on that show, and the story you're talking about is, I guess something like 1.6 or 1.8 million people applied the year that I was on it, and they kept cutting, and they cut us down to 50. The top 50 in LA at this hotel at Santa Monica, and they were doing IQ tests and all these interviews and everything, and you kept seeing people disappear as the week was going. We're not allowed to talk to anybody because they wanted the first time you to meet on camera. But you kept seeing less and less people at these things. And finally, it was a very last couple of days. And, they said, okay, here's the deal. All the NBC brass is upstairs and they want to meet with you. And okay, cool. So my little handler guy grabs me, got a dear friend of mine now, still to this day, named Paul Gordon, grabs me and says, okay, let's go upstairs. I walk upstairs and I walk in and there's Burnett sitting there, and Mark Burnett, the producer of the show, and he's eating M&Ms. And I stick my hand out and shake his hand, and he puts an M&M in my hand. And I said, it rattled me. Like, he didn't shake my hand, but he just put an M&M in it. And then, then the interview went, it didn't go very good. It wasn't my best. I felt like I was trying to be something I probably wasn't. And when it was over, I went back down to the room and I basically started packing my bags. I'm like, man, I just completely screwed this up. And anyway, they come back down about an hour and a half later and they say, they want to see you again. And I'm like, all right, you know what? If I'm going again, I'm going on my terms. This time I'm going how I want to go. So I go to the mini bar real quick, crash that thing open, walk in the room, and when I get upstairs, there's these two double doors that open up. Kind of hit them with my foot, kind of opened real fast, and one of them hit the door. And all the people jumped. And I walked in, and I looked at Burnett, and I said, let me tell you something. The reason you should put me on your goofy little television show is you invest in me, you can make back 100 times what you invest. And I pulled a bag of M&Ms that I pulled out of the mini bar, out of my pocket, threw them in his face, and I walked out of the room. That was my second interview. And as soon as the door shut, I heard everybody in there start laughing. And I figured that was probably better. And yeah, that bag of M&Ms and me being a jacknuts is how I got on The Apprentice.
So good. Okay. So anyway, now that we have that awesome story out of the way, keep on going. Tell us what got you into real estate here.
So again, Kendra got me into real estate, and we were doing projects during the boom at that time. 05, we're still booming. We're selling condo conversions all over the country. 3 of those projects were here in Vegas. I started coming out here, and then, as the story goes, met a girl, and started coming out here every weekend to see her. Luckily, I'll say that, we've been married now for 13 years and
awesome.
Got 2 kids, so it was worth it. But I came out here years ago and, started just having a real estate team. And that very quickly, after a couple of years when the market fell apart, I was one of the first people that I knew out here that got heavily active in learning how to do short sales. We were very good at that. That led into REOs, where I was the #1 agent in the country for LPS, that lender processing services, who went down for the robo-signing deal. But I was their #1 REO agent, which was great. Which again, and I'm going to preface this real quick. as I sit here and I'm going to paint the picture about the market or my opinion as to why it won't crash back to the levels it did in '08, this is one thing I want you to understand. I wish that would happen again.
Right.
It would be fucking great for me if that happened again, because I would wake up in the morning, I'd put on a pair of board shorts, I'd throw on flip-flops, I would drive to my office because it didn't matter. I wasn't going to see anybody. I'd walk in, turn my computer on, and I'd have 30 new listings. Right. It was great. But anyway, so REO kind of came and went, then got moved over into luxury, then worked for the hedge funds. I bought a ton of properties in Vegas for both Goldman Sachs and for Blackstone when they were buying their portfolios here. In the meantime of doing all that, at one point I owned 2 Keller Williams franchises, sold those to start my own company now, 10 years now. We've been doing that. That's Simply Vegas. For the last 6 years, we've been the 3rd largest brokerage in the state of Nevada by volume. We also own title and escrow company, Clear Title. We also own Mortgage Streamline. So we are completely vertically integrated. We've got 400 and something agents that work for us. And yeah, we close about 4,000 transactions a year. So I live in these numbers. I live in the market. I'm not that broker that sits that sits in the back room and just waits for my money to roll in. We're actually working in this market every day. So
that's awesome. And that's why I wanted to bring you on, because I know how in it you are. You're not just managing and overseeing, you're in it and you're doing it. So, you had a Facebook Live video, and that's what brought us to me wanting to have you on the show. You were very, very certain that this is not going to lead to any sort of market correction, market crash. And I want people to hear it the way that I heard it from you, and just kind of share where you're getting all this information and what you think.
Well, I think here's the idea.
Yeah.
Market is different than market crash. When people talk about '08, especially here in Las Vegas, this was ground zero for the foreclosure crisis. Mm-hmm. You're talking about pricing cut 50 to 55% across the board. Wham. And I mean, at some points, you were just giving houses away. And that's what people seem to be fantasizing that is going to happen again, because, my cousin said so, or my friend's dentist told me, and they've bought houses before. Okay, that's the advice that people are getting.
Right. And
the biggest problem, this is a twofold problem. The number one problem is the information sucks. It's just bad. Number two, the second fold problem is realtors don't do a good enough job of getting out and being at the forefront of our industry. They allow the media, they allow people's cousins, they allow everybody else in the world to inform the consumer as to what's going on in our market instead of us doing it. And that's what the video that I made the other day was trying to incentivize, or trying to actually, forcefully make, because you'd feel bad if you didn't do it, forcefully make agents, to work, to get up and go and be the focal point. I think what you're referring to is why we won't have a market crash, why we won't go back to those '08 prices. Let's talk about it.
Right.
Now, the first thing is you have to look at what caused that crash in the first place, what is it now, 15 years ago. If you look at how the lending industry was being run at that time and what was driving our market, it was all bullshit. I mean, if you've seen The Big Short, if you haven't seen it, you should go watch that movie. But almost all of the loans that were being done here in Las Vegas were 80-20 loans. 80% was the conventional part of the loan, and then 20% was basically a HELOC to cover the remainder of the down payment. There was a lot of that stuff getting done. No job, no income, no verification, which is why you had cocktail waitresses that owned 10 homes. And it happened a lot. In The Big Short, they said stripper, but here in Vegas, it was all cocktail.
Right.
Because they make a bunch of money, they had a bunch of cash, and they were just turning and burning. So the problem is you've got a whole marketplace full of something that nobody put any money into. It was basically just handed to you.
Right.
Here you go. Here's something that you can just have. The only cost is your credit, which is paper. And, if it goes up, you make money. There it is. And then as the market started to collapse, well, you got no money in it. The interest rate just went up. Nobody's renting it. It's just sitting there vacant. So what do? You do what so many people here in Las Vegas did. You walk away. You just walk away from those assets. Well, like I just told you a minute ago, then in '09 to '12 or '13, the hedge funds came in. And man, they came in heavy. I'm talking about tons of money. And I know because I personally worked for Blackstone and I personally worked for Goldman Sachs during that time, helping to assemble their massive portfolios. And there were a lot of other companies in town doing the same thing at the same time, buying up cash. And if you looked at our MLS at the time, so much of the majority, for years of what was getting sold month in and month out was all cash. cash in, cash out, cash out. So my opinion is this. What that has done, you haven't seen any large portfolio reductions over the last 4 years in Vegas. Now, keep in mind, I do want to stress something else. I am not a talking head for the U.S. economy or the U.S. real estate market. I am talking specifically about our market. And the reason it's so important that you listen to people in your market, wherever that is because real estate is microeconomics. It's not necessarily driven, and especially when you have a market like Las Vegas. What makes Las Vegas so different than any other real estate market is people don't understand this. Like you go to Phoenix, and you're, I think, in Arizona now, right?
Yep.
All right. You have something called urban sprawl in Phoenix, right? Where, how long does it take you to drive across Phoenix now? How long?
Oh man, I mean, the whole part of Phoenix is like 2 hours in radius.
It's crazy because now it's just another little city pops up and another little city pops up, and it just keeps growing and growing, which is why in California, if you get on the PCH, you drive from one end of California to the next and you never really leave civilization because it's all the cities have just sprawled to each other.
Right.
All right. Well, in Vegas, we're basically an island. We're just surrounded by sand instead of surrounded by water. Which makes it very easy for a market to be manipulated by the hedge funds, which is why we are always the petri dish for everything that comes out. They love this market because it's easy to pop the numbers around if you just spend enough money. It's pretty simple to do it. But you have all these hedge funds that have bought all these properties, all these portfolio managers, all this money poured into here for years and years and years and years and years. Now, that to me has created an artificial safety net. All right, that is going to hover below our market, preventing it to going to 08 crashes. Now, houses are not stocks. You can't throw them up on a sell order and they're gone in 15 minutes, 10 minutes, 8 minutes, 5 minutes. It doesn't work that way. It's a slow-moving ship that you've got to guide in one direction or the other. It's not just you can't just liquidate a portfolio in a day. You can't do it.
No.
So the hedge funds understand this. So if prices start to recede, all right, one of two things is going to happen. You can either say, man, the price of my investments is dropping, now would be a good time to sell it. But if I'm a portfolio manager and I've got 400 homes in one market in Vegas, and I say we're going to liquidate all these, if I sell all 400 of those homes, you're not going to sell them all to one person, and you're not going to sell them all at the same time. You're going to demolish the value of the rest of them by putting the whole portfolio out. The reality of that is the people that are running these hedge funds are way smarter than me, and I can figure this out. What they're going to do is, as prices start to recede, they would start to say, okay, where's interest rates today? Where are they? Oh yeah, they're almost zero.
Almost.
Right? So I, as Blackstone or Goldman Sachs or the big funds, can go to any bank and pull almost a no interest loan just to get the money in the market, get it moving. And then I can go out and start buying the stuff that's falling to hold up what I already own. It's a very simple investment concept called dollar cost averaging. If I buy a stock at 10, and then it drops to 5. If I buy the same amount I bought at 10, well, now I buy it at 5, I'm in the whole investment at $7.50. If I liked it at 10 for the long term, I love it at $7.50. And I think that thought process is what's going to continue to drive the big dollars that have come into our market. Now, do we have some challenges with unemployment? Absolutely. Are those things that I feel are going to be more short-term than long-term? In the hospitality sector, which is a large part of our jobs, I understand that. Mm-hmm. It is going to be a problem easily through the first of the year. Easily through the first of the year.
So, John, back up 1 second, because I know I understand what you're talking about there. I want people to hear it one more time about that. What did you call the dollar?
Dollar cost averaging.
Dollar cost average. So you talked about it dropping and then buying more at that cost so that you're able to basically create that safety net. Break down those numbers just one more time. So.
Well, again, what I'm saying is if I buy 10 shares of a stock, yep. Okay, let's talk about stock market. I buy 10 shares of a stock that I think maybe not this. I'm not day trading here. I'm long-term investment trading. And I say, you know what? Disney today is trading for $10. I think Disney's going to go to $50 in 10 years, 7 years, whatever. I'm Warren Buffett thinking long-term, don't buy a stock you wouldn't hold forever. So let's say I think that Disney's going to go to 50. So I got $100 and I say, wow, you know what? I'm going to buy 100 shares of Disney. All right. So I got I got $100 to buy 10 shares of Disney. Right. Yeah. So now let's say tomorrow, for whatever reason, The Rock refuses to make any more Disney animated movies. Everybody freaks out. Oh God, The Rock's not doing it. Disney stock is going to plummet without The Rock. They're over. And the stock was to drop to $5. And you see it as a momentary blip in the market where you go, the market goes down because they go up and down. And you say, now Disney's at $5. Well, if I buy $100 more of Disney, now I bought 20 shares, so I own a total of 30 shares. Mm-hmm. So if I take $200 and divide it by my total 30 shares, I'm now in at $7.50 a share, which is better than my initial investment that I liked so much for the long term in the first place.
Okay, good. All right. Thank you for breaking that down. So the other part that you said there is going to be the unemployment side of it. So sure. Why don't you see that affecting it as much as maybe some other people are?
Here's why. Two reasons. Number one, the financial crash that happened last time, every single big bank, for the most part, got completely bailed out by the U.S. government. The U.S. government understands that they have a short-term problem right now with ready to cash for the American public to get through this coronavirus problem. They understand that. They've already done some things to act on that, albeit probably, in some cases misguided, in some cases good. But yeah, through the Paycheck Protection Program, through the $600 plus on unemployment, those things they've done to try to help the American public get through in the short term. Mm-hmm. That does not, however, account for defaults that are coming in both residential and commercial real estate, which I think we are going to see continue to rise over the next little bit based on people's inability to pay their mortgage. Now, here's where I think the banks are going to get creative. One of two things is going to happen. Either A, they're going to say, look, you guys are trying to protect the American public by not telling their tenants not to pay. It's hurting our landlords. They can't pay their mortgage. We need to help them. You need to help us help them. There's going to be that play, which I know is bound to be coming because it's just bound to be coming. Yep. But then the second thing you're going to see is the banks go directly to the consumers and say, look, here's the deal. We understand you're a dealer at Caesars and you just got laid off. But we're looking at, we're doing now a quick, we're pulling a quick automated appraisal of your house. And the automated appraisal of your house as of today's value says it's worth $290. Okay. You owe us $220. So why don't we do this? Why don't we do, and they're going to figure out a way to structure that equity to make these payments. They're going to figure out a way to do it, to capture some of that because it protects their long-term investment as far as holding the equity up to keep the foreclosure. Banks don't want properties back. That's the worst thing for them. They don't want them back. It's too much of a headache. It's too much of a pain in the ass. They don't want to do short sales. They don't want to do any of that stuff. They just want to keep the person in the house paying for as long as they can. And they're going to figure out a way to tap this equity to make sure those payments continue. There's way too much equity in our market based on the fact that so much property was bought cash, number one. And number two, the lending guidelines got so strengthened that people have cash in these houses. They have money that they saved up for down payments to put in these houses.
Yeah, unlike in 2008 when people didn't have cash in their houses.
They had nothing. They had nothing in them.
So have you thought about ways that you could see them being creative with that? I mean, what you just talked about there is basically about 20%. Someone's got 20% equity, and the rest of it is still on the loan. I mean, a lot of investors like myself look at that and say, well, that's about the top refinance that I can get. If I, want to refinance a house, all I can get is really 80% at the max anyway. So,
well, again, you said the key word, what you just said, investors. Right. What I'm talking about is the amount of what's more important to the volatility of our market, to the overall stability of our housing market, is the actual homeowner. Investors, yes, but they figure, like everything else, entrepreneurs are going to figure it out. I mean, we're not going to crawl into a hole and die because the winds change. I mean, as well as I do, in this business as an investor or an entrepreneur, it doesn't matter if the market's going up or going down, you can make money. It just has to be moving. It's when it stops, there's a problem. So, but as far as the stability of pricing, the average homeowner is what's really clutched. That's who they're going to be looking to help. That's what they're going to be doing. Now with you as an investor, if you've got income coming in from other places, you're going to see banks doing what they're already doing now. I mean, in some places, I think we've got a credit union here in town doing like 1/8 of a point over prime on HELOCs. That's crazy good.
Yeah.
And what we're doing, like with my title company that we own, we're doing no escrow fee for cash out refis.
Wow.
So you cash out refi, we don't charge an escrow fee.
Wow.
Because we're trying to help. We're trying to help those people and push that across. And and as a result, like last month, I think at our title and escrow company, we opened, I want to say it was 128 new deals. 85 of them were refis.
Nice. Okay.
Yeah. Well,
So I guess the other part is, and I really didn't expect to hear you be on the same side, because what you're saying is you see that there's going to be opportunities for defaults and foreclosures and everything. You just think there's going to be a lot more of the government getting involved and saying, hey, we don't.
Yeah. I mean, here's the thing. To say that there won't be a market dip in certain places. Now, we're already kind of seeing this in the high end, which is what, we do a lot of high end real estate with Simply Vegas. And the problem in the high end right now is there's no non-QM loans. I mean, we've got situations where we had deals in escrow where the lender that was going to do the loan just went out of business, literally shut their doors, because there's just nobody on the secondary market buying non-qualifying mortgages right now. But you look at the market under 300, which was where all of it is. I mean, I just did the market stats this morning. This week, 807 new homes went in escrow.
Wow.
That's crazy good. I mean, that's it. This is the time when we really started to wonder what was going to happen, because, the first couple of weeks into this, even the first month into this, you still had people that were actively really looking for a house before we got locked down. Mm-hmm. They were really into it, looking for it. But these 807 people, these are people that are like, you know what? I'm sick of being locked up. I'll put on my mask. Interest rates are an all-time low. I'm going to go buy a house. And these numbers are showing that's happening. We had 625 closes in the last 7 days. I mean, it's not where we should be for this time of year, but it's way better than I thought it was going to be.
That's awesome.
It's way better than I thought it was going to be.
Well, and I was just doing something the other day too. I started looking, and we're seeing people doing 30 showings at houses in our market in California. And it's like, wait, there wasn't even 30 showings in those when there wasn't a pandemic. So I think there's this like balance of all these pent up, hey, I just want to go buy a home while all the rates are super low. And then there's also the other side of it of people just being like, no, I think I might buy a house right now and it might not be worth nearly as much the next day. So I think it's kind of almost like balancing itself out. But you mentioned that, you're really looking at just the Vegas market. Is there anything that people who are listening right now should be looking at in their own market to make these kinds of evaluations?
Well, I think that I would definitely talk to somebody that obviously knows what they're doing. I mean, I think that one of the biggest problems in real estate investing is, not to hate on anybody that's done this, but you take a course, you read a book, and all of a sudden you're an expert. Especially on the purchase side, meet with a broker wherever you are that has been in the business for a long time in a market and can tell you, and I would ask them, what happened here between 2008 and between 2012? What percentage of our homes here sold cash? Tell me where the funds buying there, because they were buying in pockets all over the place. Mm-hmm. It just depends. But if they're like, well, 8%, well, I might be a little more leery. You may not have the safety net that we have here. It just depends. But I also think that how these governors are handling the opening is going to affect it as well. There's so many factors. There's so many factors that go into it. But I really think that the number one thing that drives the market, to be honest with you, is consumer confidence. I think it's if people believe in the market, if they believe in what's happening there, I just think it's going to be fine. And I think Vegas has way more going for it now than it did in 2006. Way more going for it. As far as industry, as far as diversification, as far as geographic makeup, as far as, everything. I mean, sport, everything. We've really taken a quantum leap in the last 15 years to being an international city.
That's awesome. So there's a lot of people that are going around right now and they're saying, well, even if things get quote unquote back to normal, there's going to be that huge part of the population that just says, I don't even want to go outside my house right now. I don't want to move. I'm going to start learning how to work remotely. I'm not going to go to restaurants. I'm not going to go to sporting events. Vegas obviously is opening up a place for the Raiders to play here in the next few months. What if
that we bought very expensive tickets to, that who knows if we're even going to sit in our seats.
Exactly. Well, and even if you do, the other part of it is, the fans now that are going to buy tickets the week before the game or a month before the game or whatever have you. What if those people just aren't around because they're worried about leaving?
Here's a cool thing. Just so you know, this came out yesterday. MGM made a proposition to the NBA to house all of their teams here under quarantine in a couple of different MGM hotels
Nice.
and play the rest of the entire NBA season in all of our arenas.
Oh, cool.
How awesome would that be?
That would be really cool.
Yeah, it'd be pretty cool. We'll see that. But, look, there's going to be a certain percentage of people that want to stay home, like you said, and want to do this. And I actually love those people for the real estate market in Q1 and Q2 more than I love them now. Because you know what right now is done for everybody? Every single person over the last 6 weeks has been reminded of exactly what their house does not have, or exactly what they're lacking in their property, or exactly how they're not far enough away from their children when they're trying to murder each other. Or, there's nowhere to go do a podcast. I mean, everybody has been reminded of all of these things in the last 60 days. And I think some of what we're starting to see is people that are just like, man, I need a bigger place. I need a place with this, a place with that. I need something a little different. Or, like you said, if they're going to figure out how to work remotely, sorry about that, let me kill that. If they're going to figure out how to work remotely, if they can do that, well, why do they need to be so close to where they work? Now they can move a little further away, get more bang for the buck. Maybe they can move a little further out into the burbs. Maybe they don't have to be right where they were. So I think this is really, I mean, when's the last time, I like my house, but I don't think I've ever really sat around and said, like, man, I'm so grateful that I have this office so I can do this and not have to do that. I mean, it's just kind of had it.
Yeah.
So,
yeah. No, absolutely. Those are good points. So, I guess just one last thing as we kind of close up here, how can people follow you? How can they see what you're putting out there? Any ways for them to connect?
Yeah, easiest way is obviously Instagram at the John Gafford. Just look for me there. And then you can always catch me on Facebook too. John Gafford, follow me there. I try to post actually different content on both, so I'll just double everything up.
Yeah, no, you put out great content, man. You have obviously a ton of knowledge, and would love to be able to have people go see where your content's at. But last thing here, what is one little part of imparting or departing advice here that you can give to people as we're about to end this thing right now?
Well, I think hopefully most of your people. I mean, I think most of your people are probably either flippers or holders. I would be, I have a lot of flippers that work for us that flip a tremendous amount of homes that just hang their brokerage, hang their license with us. And we have conversations a lot. And I would say right now, the advice I'm giving them is don't bite off more than you can chew as far as taking big money that you have to place. I think that's a mistake that a lot of people make in times like this. I think you have to buy on the cap rate and be happy with that cap, especially if you're holding with rentals. Buy on the cap rate, be happy with the cap rate, and don't look at the daily value of the house. I mean, don't if it falls a little bit tomorrow or a month from now or 2 months from now, if you were happy with the cap rate the day you bought it and the day you put the tenant in it, be happy with that cap rate. Now, if your business model predicates on continuing to lever deals forward that you get and they appreciate you lever and buy another one, be careful.
Okay. Cool. Thank you so much, John. Appreciate you being on the show. Tons of value. And thank you so much for helping our audience to conquer the world of investing.
Yeah, man. My pleasure. Anytime.
You can check out these show notes at fearlesskyle.com/John Gafford, JohnGafford. And you can get connected with him on social media, just like what he talked about, the John Gafford. Real easy to go ahead and take a look at him on social media, Instagram, Facebook, all over the place. He's got some great stuff and just a real good guy to follow. So if you like what he had to share today, go follow him. Go take a look at his content and keep on plugging in here on the Fearless Investor Podcast, where you can conquer the world of investing. We will talk to you next time.